Most people I talk to in their 50s and early 60s obsess over one number, their account balance. They'll tell me they've got $1.5 or $2 million saved up and feel pretty good about that. But here's the problem. That number is only half the story, and it might be the less important half. The question that actually matters is this: how much spendable income will that portfolio produce when you retire? And I'm not talking about some theoretical number on a spreadsheet. I'm talking about real after-tax dollars that you can spend on groceries, travel, and everything else you've been dreaming about. I'm PJ Gibbs, a CFP with over 10 years of experience helping families transition into retirement with confidence. Today, I'm going to walk you through exactly how to calculate your real retirement income potential, and the answer might surprise you. Let's imagine a hypothetical scenario. You've got $2 million saved for retirement. Sounds pretty comfortable, right? You run the quick math in your head using that famous 4% rule everyone talks about. That's $80,000 a year. Add in Social Security and you're thinking you're all set. But here's what most people miss. That $80,000 isn't what you actually get to spend. If all $2 million is sitting in your 401k or traditional IRA, every dollar you pull out is taxed as ordinary income. Let's say you're married and that $80,000 withdrawal pushes you into the 22% federal tax bracket for 2025. Suddenly you're losing $17,600 to federal taxes right off the top. That's before we even talk about state taxes if you live somewhere like California or New York. So your $80,000 just became $62,400 in actual spending power. And that's the problem with focusing solely on your account balance. It doesn't tell you what you can actually afford to do. This is what I call accumulation thinking versus distribution thinking. During your working years, you're focused on growing that account balance. But in retirement, the game changes completely. Now it's all about turning that balance into reliable, sustainable income and doing it in the most tax-efficient way possible. When you're figuring out how much income your portfolio will actually generate, there are three major factors that can dramatically impact what ends up in your bank account. Let me break down each one. You've probably heard about the 4% rule. It was created back in the 1990s by financial advisor William Benjamin, and it says you can withdraw 4% of your portfolio in the first year of retirement. Adjust that amount for inflation each year, and your money should last at least 30 years. But here's what's changed. Morningstar's latest research for 2025 actually suggests a starting withdrawal rate of 3.7% might be more realistic given current market conditions and projected return. On the flip side, Benjamin himself has updated his research to suggest that rates as high as 4.7% might work for some retirees depending on their asset allocation. But what does this mean for you? If you've got $2 million and you use a 3.7% withdrawal rate, that's $74,000 in 1 year, not $80,000. And remember, we still haven't accounted for taxes. This is where things get really interesting. And most people leave tens of thousands of dollars on the table every single year. Not all accounts are created equal when it comes to taxes. Let's look at a hypothetical example of someone with that same $2 million, but split three different ways. In scenario one, all $2 million is in a traditional 401k. So using a withdrawal rate of 4%, you take out $80,000. At the 22% federal bracket, you net about $62,000 after federal taxes. Scenario two is a balanced approach with $1 million in a 401k, $500,000 in a Roth, and $500,000 in a taxable brokerage account. Now you're pulling $40,000 from the 401k, which is taxed as income, leaving you about $31,000 after federal taxes. $20,000 from the Roth, which is completely tax-free, and $20,000 from your brokerage account. That brokerage withdrawal might be mostly long-term capital gains, which are taxed at just 15% for most retirees, which leaves you with $17,000 after taxes. So if you add it up, that's $31,000 plus 20 plus 17 equaling $68,000 in spendable income. Same $2 million, same 4% withdrawal rate, but with smart account diversification, you just put an extra $5,800 in your pocket every single year. Over a 30-year retirement, that's $174,000 more dollars you get to spend just by being strategic about which accounts you tap first. Here's something that keeps me up at night for clients who are about to retire: sequence of returns risk. Imagine two people who both retire with $1 million. Over the next 30 years, they both average 6% returns. You'd think they'd wind up in the same place, right? Wrong. Let's say the first person retires in 2008, right as the market crashed. Their portfolio drops 30% in 1 year. They're withdrawing $40,000 to live on, so they're selling shares at the bottom. That portfolio takes a massive hit it might never fully recover from. The second person retires in 2009, right as the market starts its recovery. They get a few years of strong returns before any downturn. Even though they average the same 6% over 30 years, this person's portfolio ends up significantly higher. This is why I tell clients approaching retirement, it's not just about your average return, it's about the order in which those returns happen. Bad returns early in retirement can be devastating, even if things improve later. Let me share a real framework that I use with clients to help them understand how different account types produce vastly different amounts of spendable income. Think of your retirement accounts in 3 buckets: taxable, tax-deferred, and tax-free. The taxable bucket includes your brokerage accounts, joint accounts, and any non-retirement investments. When you sell investments here, you pay capital gains taxes. But here's the good news. Long-term capital gains, which are on investments held for more than a year, are taxed at either 0%, 15%, or 20%, depending on the rest of your income. For most retirees, that's going to be 15%, significantly lower than ordinary income tax rates. But here's something most people don't know. For married couples filing jointly, in 2025, you can realize up to approximately $94,000 in long-term capital gains and pay 0% federal tax on it if you have no other taxable income. That's a massive planning opportunity. The tax-deferred bucket is where most people have the bulk of their money. Traditional 401ks and IRAs. Every dollar you pull from these accounts gets taxed as ordinary income. For 2025, federal tax brackets for married couples filing jointly go from 10% up to 37%, with most retirees falling into the 12 or 22% brackets. But here's the kicker. At age 73, the IRS forces you to start taking required minimum distributions, or RMDs. Whether you need the money or not, you have to withdraw it and pay the taxes on it. This can push you into higher tax brackets and even impact things like your Medicare premiums. The tax-free bucket is your Roth IRA and Roth 401k. Money comes out completely tax-free in retirement. No income to report. No impact on your tax bracket. This is the most valuable bucket you can have, which is why I'm constantly strategizing with clients about Roth conversions in those early retirement years before those RMDs kick in. So let me walk you through a hypothetical example that I use all the time with clients to illustrate this concept, because seeing the actual numbers side by side is eye-opening. Couple A has $2 million, all in traditional 401ks and IRAs. They retire at 65 and start taking 4% withdrawals, which is $80,000 per year. Since they're in the 22% federal bracket, after taxes alone, they're left with $62,400 in spendable income. And in state taxes, they live in a high tax state, and it could drop to $55,000 or less. Couple B also has $2 million, but they've been more strategic. They have $800,000 in traditional IRAs, $700 in Roth IRAs, and $500 in taxable brokerage accounts. They take $32,000 from their traditional IRA. After taxes at 12%, that's about $28,000. $28,000 also from their Roth, so being tax-free, that's a full $28,000. And then another $20,000 from their brokerage account. Let's say $15,000 of that $20,000 is long-term capital gains taxed at 15%, which leaves them with almost $18,000. Total spendable income, 28 plus 28 plus 18, is roughly $74,000. Same size portfolio, similar withdrawal amounts, but Couple B has $11,500 more to spend every single year. Over a 30-year retirement, that's $345,000 in extra spendable income, all because of how they structured their accounts. Now here's where retirement income planning gets really interesting. Most people aren't living solely on portfolio withdrawals. You've likely got Social Security coming in, maybe a pension, perhaps a rental income or part-time work. Let's talk about Social Security first, because this is another area where taxes sneak up on people. A lot of folks think Social Security is tax-free. It's not, at least not for everyone. The IRS uses something called combined income to determine if your Social Security is taxable. That's your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If that number exceeds $32,000 for married couples filing jointly, up to half of your benefits become taxable. If it exceeds $44,000, up to 85% of your benefits are taxable. Here's a hypothetical scenario. Let's say you and your spouse receive $40,000 a year in Social Security benefits. You also withdraw $60,000 from your traditional IRA. So your combined income is $60,000 plus $20,000, or half of your Social Security, for $80,000. That's way over the $44,000 threshold. So up to 85% of your Social Security is now taxable income. Suddenly, your $100,000 in total income, $60,000 from your IRA, $40,000 from Social Security, has $94,000 that's potentially taxable. You can see how this adds up fast. Now, what if you had done Roth conversions earlier and were pulling from a Roth IRA instead? Roth withdrawals don't count toward combined income. So in this hypothetical scenario, you could withdraw $60,000 from your Roth. Your combined income would only be $20,000, and your Social Security would be completely tax-free. That's a huge difference. Pensions work differently. They're fully taxable as ordinary income, similar to IRA withdrawals, but they also provide guaranteed income, which reduces the amount you need to pull from your portfolio. That can actually lower your sequence of returns risk because you're not forced to sell investments during market downturns to cover basic expenses. As you get closer to retirement, your investment allocation becomes critical, not just for growth, but for generating reliable income. During your accumulation years, you might have been 80% stocks or 20% bonds. You are focused on growth. But as you approach retirement, you need to shift your thinking. You're not trying to maximize growth anymore. You're trying to generate sustainable income while managing the risk. Most research suggests retirees should have somewhere between 40% and 60% in stocks, with the rest in bonds and cash. Why? Because you need that bond and cash portion to provide stability and income during those inevitable market downturns. Here's how I think about it with clients. You want 2 to 3 years of living expenses in cash or very stable investments. This is your safety buffer. If the stock market crashes 30% in year 2 of your retirement, you're not forced to sell stocks at the bottom. You live off your cash buffer while your stock portfolio recovers. The rest of your portfolio stays invested for growth because, and this is important, you might be retired for 30 or even 40 years. You still need growth to keep pace with inflation. According to recent research, a balanced portfolio with around 50 to 60% stocks has historically provided the best combination of growth and stability for retirees. Let's bring this all together with a simple framework you can use to estimate your own retirement income potential. Step 1, calculate your total portfolio across all accounts. Step 2, determine a reasonable withdrawal rate. I'll use somewhere between 3.5% to 5% for most clients, but this can vary based on your age, risk tolerance, and time horizon. Step 3, break down your accounts by type. How much is in traditional tax-deferred accounts, how much in Roth, and how much in taxable accounts. Step 4, estimate your tax impact for each bucket. Traditional accounts taxed as ordinary income at your marginal rate, Roth accounts tax-free, and taxable accounts likely 15% capital gains for most retirees. Step 5, add in your other income sources, Social Security, pensions, rental income. Remember to account for the taxation on Social Security based on what your combined income is. Step 6, calculate your actual spendable income. Let me walk through a quick hypothetical example. We're going to take a total portfolio of $1.5 million. It's broken down into $900,000 in a traditional IRA, $400,000 in a Roth, $200,000 in a taxable brokerage. Using a 4% withdrawal rate, this is $60,000 of total withdrawals. We'll take $36,000 from the IRA, withhold 22% for taxes, $16,000 from the Roth, which is tax-free, and then another $8,000 from the brokerage. So after 15% capital gains, that's $6,800. The total spendable from the portfolio is $50,880. We add in $35,000 of Social Security, add Social Security of $35,000, which about 70% will be taxable due to the combined income, netting about $31,690 after taxes. Your total spendable income is approximately $83,000. That's your real number, not $1.5 million, not even the $95,000 gross income. It's the $82,570 you can actually spend. Most financial planners, including myself, recommend that retirees plan to replace about 70 to 80% of their pre-retirement income to maintain their lifestyle. So if you were making $100,000 before retirement, you'd want to spend between $70,000 and $80,000 in retirement income. This example gets you right into that range. So what should you do with this information? First, if you're several years away from retirement, focus on account diversification. Don't put everything into traditional 401ks and IRAs. Consider Roth contributions, especially if you're currently in a lower tax bracket. Build up that taxable brokerage account too. It gives you flexibility. Second, if you're within 5 years of retirement, start running detailed projections. Don't just look at your account balance. Calculate your actual after-tax income using the framework we just outlined. You might be surprised at how different the numbers look. Third, consider working with a CFP who specializes in retirement income planning and tax strategy. As a financial advisor with over 10 years of experience, I can tell you this is one of the most complex areas of financial planning. Having someone who can model different scenarios and optimize your tax situation can easily pay for itself many times over. Fourth, think strategically about when to claim Social Security. Every year you delay between 62 and 70 increases your benefit by roughly 8%. For many people, delaying makes sense, but it depends on your overall tax situation and other income sources. Finally, remember that retirement income planning isn't a one-time calculation. It's an ongoing process. Tax laws change, your spending changes, market conditions change. What works in year 1 of retirement might need adjustment in year 10. The bottom line is this: your portfolio balance is just a starting point. What really matters is how much of that money you'll actually be able to spend after taxes throughout a retirement that could last 30 years or more. With smart planning around account types, withdrawal strategies, and tax optimization, you can potentially put tens of thousands of extra dollars in your pocket every single year. If this video helped you think differently about retirement income, I'd love to hear from you in the comments. What surprised you most? Are you feeling more or less confident about your retirement income potential? At Trello Wealth, we help families and retirees simplify financial complexity with personalized planning and disciplined investment management, so they can move into retirement with clarity, confidence, and peace of mind. If you want help calculating your real retirement income potential and optimizing your strategy, schedule a call with us using the link in the description. You can download our free retirement readiness checklist to make sure you're on track.